There's roughly $16 trillion sitting in cash and cash equivalents in the United States right now. And for the people who own that money, it earns almost nothing. Don't believe me? Check how much you made last year on your 1099 interest or 1099 dividend on your savings accounts, checking accounts, and money markets. But for the banks holding it, the math looks completely different. When you deposit money at a bank, that money doesn't sit in a vault waiting for us. Banks use a system called fractional reserve banking, which historically allowed them to lend 9 times what they had in deposits. So you put in $1 and they can use 9 times that, really phantom money, to leverage it outside. So the $10,000 sitting quietly in your savings account might help generate $90,000 in loans across the broader banking system. They even passed a law recently to allow 0% held in deposits, so everything can be leveraged. Your money is working constantly, just not for you. For decades, the banks holding your deposits were legally prohibited from gambling in financial markets. But that changed in 1999. President Bill Clinton signed the Gramm-Leach-Bliley Act, the GLB, which removed the barrier from the same banks that held the deposits to then be allowed to also be investment banks. And that had been in place for a pretty long time from the Glass-Steagall Act. After that law passed, banks could suddenly combine deposit accounts, investment banking, securities trading, insurance, lending, all of it. They made what became known as the modern financial supermarket. And the same institutions holding trillions of dollars in ordinary American savings could now deploy that money, that capital, directly into the financial markets for themselves. And most people have no idea that that law exists or that it even changed. Most people don't realize that banks don't just lend money. They create new money when they issue loans. When a bank approves a loan, it doesn't pull cash out of the vault. It doesn't take it directly from the deposits. It creates a new digital deposit in your account. It's new money, and that loan becomes new money in the economy, while your obligation to repay it becomes the bank's asset. This is a large part of why they compete so aggressively for deposit accounts. In Canada, when we lived there, I would see, get an iPad for opening an account. There's cash bonuses, there's giveaways, because deposits are the raw materials that allow the entire financial system to expand its lending capacity. The money you park quietly in a checking or savings account becomes the fuel for the entire lending machine, and understanding that changes how you think about where you keep it. The average credit card interest rate in America is currently well over 20%, with some cards charging 28% or more. In my 20 plus years, I don't think I've ever seen rates this high on credit cards across the board. It used to just be store cards. And the reason that number is so high comes down to one very simple piece of math. Banks borrow money incredibly cheap. Deposits can cost them anywhere from like 0.01 cents to 1% in interest paid to you. That same financial system turns around and lends money back to consumers at the 20 to 28% rate. The difference between those two numbers, this is key, is called interest rate spread, and it's one of the most powerful profit engines in all of banking. If money compounds that powerfully when banks are on the lending side of it, the question worth asking is whether it should be compounding that aggressively for you too. Big banks compete aggressively for deposits, and it has nothing to do with wanting to hold your money safely. Deposits are simply the cheapest fuel available in finance. Deposits allow banks to issue loans, invest in securities, support derivative trading, and expand their overall lending capacity. The more deposits they control, think the more cash in hand for them that they have to pay you a tiny fraction of 1%, the more financial activity they can generate across the entire system. And every dollar you or I or a consumer parks in low yield accounts is a dollar contributing to that engine. Your savings account is not just sitting there. It is an illusion that they are holding the money. It is actively powering a financial ecosystem, and the question is whether you're getting a fair share of what it generates. It's your money after all. There is one place where the math on all of this changes pretty significantly, and most people either don't know about it or don't think it applies to them. So credit unions are member-owned nonprofits, which means instead of profits going to shareholders or flowing up to a big company, they go back to members through higher interest rates, lower fees, better loan terms. So last week I decided to do some research, and I personally opened an account at a credit union. They gave me 5.3% interest on my high yield checking account, not savings savings even checking. A couple rules like deposits in and transactions, but nothing even about a balance. That is more than 10 times more than I was getting at a major bank on the exact same dollars. Same money, different structure, very different over time if you let that difference compound. Now, still, leaving money there is not going to be enough. I need to put my money to work. But if I need to keep some liquid, accessible, and emergency fund, I might as well take it out of the system and put it somewhere where it works for me. Warren Buffett has said directly that cash is one of the worst long-term investments you can hold. And the reason he says that is worth understanding. He is arguably the best investor ever. Inflation quietly erodes purchasing power over time, regardless of what your account balance says. If inflation averages 3 to 4% and your savings account is paying 0.5% or 1%, it's pretty obvious you're losing purchasing power every single year, even as your balance technically grows. Cash absolutely has a role in a healthy financial plan, particularly for safety and liquidity, but it's a tool for a specific job, not a long-term wealth building strategy, not a tool for all situations. Long-term wealth comes from putting money to work, and the first step is making sure that the money sitting in your accounts is working in your direction instead of someone else's balance sheet.